Good morning, everybody. Good morning, everybody. Happy Thursday. Happy Bubble Day. Today is December 14th, 2023. Top story, Jerome Powell has surrendered. As my friend Mario Ineco over at Mineco64 said this morning, Powell folded like a cheap suit. Janet Yellen ate his lunch. The fiscal dominance is in full effect. Janet Yellen is the fiscal dominatrix. Jerome Powell, well, he was bent over backwards and spanked at the Federal Reserve yesterday because he has absolutely, unequivocally surrendered. And the pivot, it hasn't technically happened yet, but it's coming. And he told us that yesterday. The Federal Reserve left interest rates unchanged yesterday. That was not a surprise, but the big surprise was found in the summary of economic projections, the SEP, otherwise known as the dot plot, where the Federal Reserve forecast 3 rate cuts into next year. And when that came out, the market started moving higher like you wouldn't believe. Everything started moving higher. Stocks, bonds, gold, silver, Bitcoin, virtually every asset class across the board went up. The dollar went down. Interest rates went down as bond prices went higher. And then when Powell started talking, well, historically, we've seen you get this initial reaction from the Fed, and then it reverses while the press conference is going on. But that didn't happen because Powell came out like a dove. Lord, he was lovey-dovey. So if you were looking for some hawkish statements by Powell, kind of like we got a few weeks ago when he was talking at some college and he made these very hawkish statements and the whole market said, you know what? I don't believe you. Well, I guess Powell didn't even bother with the charade yesterday, and the market just gobbled it up like you wouldn't believe, and that's continuing into today. We had the Dow Jones made a new all-time high yesterday, breaking above 37,000. The S&P is not at an all-time high, but it did break above 4,700 yesterday. Now we are just, I believe, 90 points shy of an all-time high in the S&P. And we got a couple of those points already this morning ahead of the opening bell, so it looks like an all-time high in the S&P is in our sights here. The NASDAQ is also rallying. The 10-year yield is now below 4%. We were just above 5% a few days before Halloween. You guys remember that? And just down we go. Ever since Bill Ackman announced he was covering his short, yields have just plummeted. So, has the soft landing been achieved? Is it mission accomplished? Is everything all well on Wall Street? Well, no, of course not. All the underlying weaknesses in the economy remain. You see some of that even today. The International Energy Agency is out. They are lowering their forecast for oil demand in the fourth quarter by 400,000 barrels a day. Oil consumption slowing is not an indicative of economic health, of economic prosperity for people. We got continuing jobless claims rose again this morning, albeit a smaller increase than we've seen in some recent weeks. And another thing to warn about, there's a chart from Reventure Consulting that was going out on Twitter. Really good one. Be careful, guys. The first rate cut, even though the market is celebrating it, it's not always an indicator of good things to come. As a matter of fact, it's usually the opposite. Bad things tend to happen just after that first rate cut when it hits. But as for today, the market doesn't care about history. The market doesn't care about what usually happens at the beginning of a loosening cycle or at the end of a tightening cycle. The market doesn't care. Number go up. So the bulls are taking a victory lap today. Everything is up. Congratulations to you perma bulls. You guys are right again. Congratulations to the silver stackers and the gold stackers. You guys were also right because gold is surging right now near an all-time high, recovering a lot of the losses of the last few days. Bitcoin was even on fire yesterday, up over $1,000 yesterday, even though Senator Pocahontas is trying to kill crypto with her new bill that just basically rolls out a CBDC and bans Bitcoin. Good luck with that, Senator Karen. Why don't we shrink my big melon of a head and see what's going on in markets this morning? And guys, while we're doing that, don't forget that like button. It really does help with the YouTube algorithm. And if you're new to the channel, hit that subscribe button. We do this every morning. Have your coffee with the melon heads. And we haven't been on the fear greed index in a couple of weeks here because it really just wasn't working. We were in extreme fear a couple of weeks ago while the market was going vertical straight up. So we stopped looking at that. But just for posterity, let's take a look at it today. 71, we are only a few points away from extreme greed now. That needle has swung so far, so fast. And well, the market is, look, it's obvious. You can see it. Turn on CNBC. Jim Cramer is just glowing right now. I mean, they are just loving it. The money printers are coming back. ZERP is coming back, or at least we are trending in that direction. And they are just picking out. But guys, I got to warn you, euphoria, buying into euphoria doesn't always well. Selling into a panic doesn't always end well. And buying into euphoria also doesn't always end well. The S&P 500 this morning is up 28 points ahead of the opening bell, 0.6% higher. That is on top of that rip your face off rally from yesterday. Again, in striking distance of an all-time high. Take a look. There's your all-time high closing from back in January of 2022. I believe 47.97 thereabouts was the all-time high. I may be off by a point or two there, but that's pretty close. We are now at 47.07, just 90 points away from an all-time high in the S&P. The Dow, meanwhile, is up another 220 points this morning ahead of the opening bell. That's after being up 500 points yesterday following Powell's press conference. Guys, after the announcement of no hike, the Dow started the rally, and it just continued all the way through that press conference, and it never stopped into the close, through last night while we were sleeping, into this morning. Number go up. The Dow now at an all-time high. And the NASDAQ is getting in on it too, up another 75 points ahead of the opening bell, or about 0.5% higher. And the NASDAQ still well off its all-time high from late 21, early 22, but also getting there, still rallying like the blazes. And the dollar, well, the dollar's doing the opposite because, well, what we're watching here is not the health of businesses improving. What we're watching is not economic prosperity. Trade isn't increasing. There was no breakthrough at the peace table. The commercial real estate debacle hasn't been solved. No, the dollar has been debased, or at least the Fed has told us they're planning to further debase the dollar. And so the DXY has just been crushed, and that is adding buoyancy to the price of everything. The dollar is at 102.25. That's down another 61 basis points this morning. That's after losing 100 basis points yesterday because of what the Fed did. And guys, for all intents and purposes, what we're seeing right now is really just dollar debasement, or at least anticipating or front running of dollar debasement, because this market has a lot of the qualities of a flight to safety, and it has a lot of the qualities of euphoria in stocks. You've got bond prices are rallying, gold prices are rallying, silver is rallying, right? Those are safety trades when you typically see that. You see interest rates falling because bond prices are surging. People usually buy gold and bonds for safety, not because, oh my God, everything is going to be so good. But at the same time, if this was a safety trade, you wouldn't see the stocks rallying like crazy. We're also seeing that. What we're seeing is people running out of the dollar and into anything but. This is dollar debasement. Stocks go up, gold goes up, bonds go up, everything goes up. I'm assuming housing is probably going to go up too here. And I just don't know what to tell those people who have been waiting to buy a house, trying to save money, hoping that home prices come back down to earth. It's not happening this week, that's for sure. Looking over at bonds, we have got yields are sharply lower again this morning. Look at some of these numbers. The 30-year Treasury, 4.12. That's down another 5.5 basis points. The 10-year yield below 4%, 3.962, down another 7 basis points this morning. We were over 5% on the 10-year yield just about a month and a half ago. This thing is falling like crazy. The 2-year Treasury yield, 4.363. That's down 11, almost 12 basis points. And even the 1 month, guys, 5.347 on the 1 month. This thing has lost 5 basis points in just the last couple of days. The Fed has not moved the overnight rate yet, guys. It hasn't happened yet. They're just talking about it. They're just talking about lowering the rates. And already the 1 month is starting to move. So pay attention, all you T-bill and chill guys. We're starting to see those 1 month yields have come down just a little bit. Keep an eye on that one. And look at this chart of the 10-year yield. Look at this move. Ever since Bill Ackman announced he was covering his short, man, I really can't stand him. But look at that. The 10-year yield is in free fall, over 100 basis points lower in a little over 5 weeks. Just really rapid decline in the 10-year yield here, folks. Commodities also getting in on the action. We've got gold, February gold futures at $2,054 this morning. That's up another $56 today, 2.9% higher for February gold futures. March silver futures at $24.45. That's up $1.53 today, 6.7% higher for silver. Congratulations, silver stackers. I like this shiny. Doing really good this morning. Still well away. Silver nowhere near an all-time high, obviously, from 2011. And then, inflation adjusted, nowhere near the Hunt Brothers days either. Gold is still about $100 short of its intraday all-time high, but the metals are pushing all-time, at least the yellow one is pushing its all-time high here. Platinum and palladium also getting in on it. Platinum prices are up almost 3% for January platinum futures, $949. Look at palladium this morning. March palladium futures, 1,042, up 7.6%. Even crude oil's getting in on it. $71.64 for crude oil this morning, up $2.16. That's 3% higher. Even though we got this, oil is 3% higher, even though we've got headlines like oil demand growth shows signs of sharper slowdown. That is how much the dollar has been debased by what Powell said yesterday. We've got this report from the International Energy Agency, and still oil rallies. The IEA cuts fourth quarter demand growth by 400,000 barrels per day. Record U.S. supply wave is squeezing the Saudis out of prime markets. Watch that U.S. oil production, guys. It's on the rise. I showed you that chart yesterday showing oil production in the U.S. rising even as it falls in Saudi Arabia and Russia. Will OPEC Plus continue to cede market share to the United States? We will see. We're about around that price level where they would cut again. Global oil demand growth is slowing down sharply as economic activity weakens in key countries, the IEA said as it slashed estimates for this quarter. Oh, this must be the soft landing I hear so much about. Phrases like slowing down sharply as economic activity weakens in key countries. Is this a soft landing? The IEA sliced nearly 400,000 barrels a day from assessments of consumption growth for the final 3 months of 2023 and continues to expect that growth rates will decelerate dramatically next year. Meanwhile, soaring production from the U.S., Brazil, and Guyana is offsetting production cuts by Saudi Arabia and its OPEC allies, it said. Notable surging production from that Guyana. Keep an eye on Guyana, guys. That is that's where Venezuela and Guyana fighting over that Essequibo region. Haven't heard about that one in a couple of days, but that surging oil production, there's money up for grabs there, and, well, everybody wants it. Evidence of a slowdown in oil demand is mounting, the Paris-based advisor said in its monthly report on Thursday. The increasingly apparent loss of oil demand growth momentum reflects the deterioration in the macroeconomic climate. That last sentence there, again, I know the subtitles. If you turn on subtitles, I'm sure it says soft landing. But what I keep seeing is the increasingly apparent loss of oil demand growth momentum reflects the deterioration in the macroeconomic climate. Doesn't sound very soft landing-y to me, but you know what? As for today, nobody cares. The stock market doesn't care. All they care about is Fed. Forget the deteriorating macroeconomic climate. Number go up. Now, guys, I would add that the Fed did not cut rates yesterday. They're only talking about cutting rates yesterday. But this is important. We saw this chart came out from Reventure Consulting. Let me put a bigger one up here on the screen so you guys can see it a little better. Reventure Consulting put this one out. Unemployment rate from 1953 to 2023. Now, you notice, obviously, there's some big spikes in the unemployment rate in the U.S., but I want to draw your attention to these yellow lines here. Now, all the yellow lines that Reventure Consulting added to this chart, that is the first rate cut in a tightening cycle. The first rate cut in a loosening cycle, all right? And now we still haven't had the first rate cut in this cycle, so you have no yellow line in our immediately in this chart here. But look at what the unemployment rate does. Every time there is a first rate cut, look at what happens to the unemployment rate in the 3 to 6 months following that first rate cut every time. And keep in mind the euphoria going on in Wall Street right now and how stupid it's going to sound a couple of months from now, or it could be as much as a year from now, because we still don't know when the first rate cut will be. And then the spike in unemployment usually happens a few months after that. So if we get a rate cut in, say, March, then we wouldn't see the spike in unemployment until, say, June. But look, guys, it's coming every single time this happens. Without exception, you get a first rate cut unemployment spikes every single time. And hey, look at the unemployment chart. Look at 2023 there on the chart. Unemployment is already starting to tick up. We're at what? There's a 3.9%, 3.7% unemployment right now, somewhere around that. And the Fed says we're unlikely to go to 4.1%, even though that's only a few basis points up from where we're currently at. And we haven't even started with that cutting cycle yet. So shout out to Reventure Consulting for putting out an excellent chart there this morning. It's something to think about, guys. When they start cutting rates, they don't cut rates because things are so good. They cut rates because they have to. And speaking of unemployment, we got initial jobless claims this morning. Initial claims were down. That's good. Initial jobless claims in the United States decreased to 202,000 in the week ending December 9th of 2023. That's down from 221,000 in the previous week. So here's initial jobless claims, big decline. That's good. You know, initial jobless claims hasn't really been the problem, though, for these last few months. It's been continuing claims that we've been talking about on this channel. And, well, that continues to be a thing. Continuing jobless claims in the United States increased to 1.876 million in the week ending December 2nd of 2023. That is up from 1.856 million in the previous week. Now we can see here this trend, guys. Even though there's no real trend of increasing initial unemployment, we are seeing that once people go on those unemployment rolls, they're having a harder time getting off of the unemployment rolls, which means they can't as easily find work as maybe a year ago. So even though the job losses aren't really piling up, despite a lot of anecdotes, by the way, yesterday we heard about Hasbro laying people off. We heard about Etsy laying people off. Ford is cutting production of their electric vehicles in half. I don't know if that's going to result in layoffs. Probably, though, because they just announced that big contract increase for the UAW workers right before announcing a big reduction in production. It's not so hard to see. There's probably some layoffs coming at Ford in the near future. But take a look at this chart here, guys, because this continues to rise. The rise shows it looks like it's leveling off a little bit. We had that big spike to 1.9 million a few weeks ago. But even if you account for that, you do see this trend is still rising a little bit. Keep an eye on that unemployment. And again, a few months after that first rate cut, unemployment surges. We're already starting to see early signs of rising unemployment here. And check this one out. This one was produced by Carl Quintanilla today. Labor force participation rate for men aged 55 to 64. All right. So you guys who are right about retirement age, maybe just past retirement age, look at what's going on with labor force participation rate. This chart goes all the way back to January of 2004. Now, pay attention. Here's pre-COVID, right? Before the pandemic, the labor force participation rate for men 55 to 64. So again, retirement age, not quite retirement age. It was around 71.5, 72%. Now, obviously, that number came down with the lockdowns and everything, but look at what labor force participation rate among old men has done in the last couple of years. It is now over 72.5%. This is people being unretired by inflation. This is hardship, forcing old men back into the workforce. So congratulations, guys. If the virus didn't kill you, the Fed stole your retirement in the form of inflation, and now you have to go back to work at age 64 in order to make ends meet. Meanwhile, Wall Street is celebrating and telling you, you're crazy. You've never had it so good. Tell that to a guy who just had his golden years stolen from him, and now he's got to work part-time as a freaking greeter at Walmart in order to pay the bills at the end of the month. Thank you, Carl Quintanilla, for the chart this morning. Another thing to keep an eye on, this one just came out today. Retail sales in the United States increased by 4.1% in November of 2023 over the same month in the previous year. That's up pretty substantially, guys. So what I'm looking at in this chart, a 4.1% increase in retail sales. These numbers are not adjusted for inflation, so this is slightly ahead of the inflation rate. So retail sales outpacing inflation, that means you've got real sales growth in retail. So we were talking a lot about the Black Friday numbers and the Cyber Monday numbers and how some of the data from the tech companies suggested it was really good. But then we got the retail numbers from, like, say, Target and Home Depot and Walmart, and those numbers were showing same-store sales declines. So we were having a hard time rectifying those two data points. Well, this is showing a slight increase in retail sales adjusted for inflation in the U.S. This is the year-over-year number. But if you get into the month-over-month numbers, you get a little bit of a clue about what's going on here. First of all, let me show you the chart. Here's retail sales month over month. They were up 0.3%. Not a huge increase, more than the market was expecting. The market was expecting a decline of 0.1. But let's look at some of the areas where we're seeing. Figures suggest strong start to the holiday shopping season, with sales at food service and drinking places up 1.6%, non-store retailers up 1%, health and personal care up 0.9%, furniture up 0.9%. Those are all the biggest increases. Sales were up at clothing stores, 0.6%, motor vehicle parts and dealers, 0.5%, food and beverage, 0.2%. Now, in contrast, we saw a sharp decline of 2.9% at gas stations. So obviously, cheaper gas prices is contributing a little bit to the increase in holiday spend. Sales were also lower at miscellaneous store retailers. See also those Target and Walmart numbers that weren't so good. Well, Walmart numbers were pretty good. The Target numbers were abysmal, though. Electronics and appliance stores down 1.1%. Building material and garden equipment suppliers down 0.4%. There's your Lowe's, your Home Depot. General merchandise stores down 0.2%. So what I think we're seeing here is overall sales are up a little bit relative to inflation. They're way down at brick and mortar, but they are way up at online. The fact that we're seeing like miscellaneous merchandise stores, right? Your big box stores are seeing sales declines, even though the specific categories are up. This is just a shift to online buying is still going on. And if you account for the decline in brick and mortar and the increase in online shopping, you have a slight increase still in retail sales. One word of caution, though, look at those debt numbers, guys. Consumer credit in the month of November went from $1,017.5 billion to $1,034.3 billion. So we've got what is that? About a $17 billion increase in consumer credit card debt. People keep putting things on the cards. It's all debt fueled. It's not real. At some point, those bills have to get paid, guys. At some point, the deleveraging has to happen. Making problems worse and pretending things are better, not really a winning strategy. But hey, you guys do. Good luck. Good luck with that, Bulls. And one thing I want to warn you guys about, get ready for $5 eggs again. This story broke yesterday. Bird flu hits top U.S. producer. Outbreak affects hens at the Cal-Maine Foods facility in Kansas, and yet their shares jumped almost 10% on the news. So apparently a plague killing your flock is very good for business in the chicken industry. That's what the stock market said yesterday. Again, maybe we don't use the stock market as a barometer of economic health. Egg prices are likely to start rising again after a top U.S. producer had its first ever outbreak of the deadly avian influenza. Cal-Maine Foods said in a statement on Tuesday that one of its facilities in Kansas tested positive for highly pathogenic bird flu, affecting 684,000 egg-laying hens, or about 1.6% of its flock. Based in Mississippi, the biggest U.S. producer had previously avoided infections in the world's worst ever global outbreak that prompted more than 72 million birds to be killed in the U.S. to slow the spread of the virus. The latest outbreak adds to worries that a resurgence could start boosting egg prices, which have fallen 69% since hitting a record $5.35 a dozen in the Midwest about a year ago. So it's not a big, massive problem yet, but you do have a big U.S. facility. We had the first sign of the bird flu this year. 680,000 birds probably going to get cold. It's not a trend yet. It's just something to keep an eye on. We could be looking at those higher egg prices again. And last but not least, let's look at CME futures right now. Okay, the Fed rate cut. Keep in mind, guys, the Fed did not cut rates yesterday. They just said we're talking about cutting rates yesterday. And already the market is now saying an 18.5% likelihood that they cut rates as soon as next month. All right, so a 1 in 5 chance, a little less than 1 in 5 chance that they cut rates next month is what the market is already saying. Rate cuts in March are now a probability, according to CME futures, 68% likelihood of a rate cut in March. And then certainly by May, at this point, you've got a 63% likelihood of 2 rate cuts by May. But the most ridiculous thing in this chart, look at the December chart. Right now, a 37% likelihood, that's the plurality, I'll say, of likelihoods. The highest likelihood of anywhere on this chart says that the Fed funds rate in December of next year, a year from now, will be 375 to 400. The Fed yesterday said 3 rate cuts are coming next year, and the market is saying 6. 6 rate cuts are now being priced in, even though the Fed just said, we're thinking about 3. The market is saying, give me 6. Euphoria setting in across. And remember, guys, we are just only a hair below extreme greed. Be careful with this euphoria. Stocks are near all-time highs. And I want to say thank you very much to Easy Fix. Excuse me, sir. He says, but I thought Powell was the new Volcker. I think Powell fancies himself a Volcker. I think he wants to be remembered as a Volcker. But to be honest with you, I think Powell is going to be remembered as that guy wearing a tight leather suit with a gag ball stuffed in his mouth while Janet Yellen spanks him saying, rate cuts. And he says, thank you, ma'am. May I have another? Because the fiscal dominance right now, you didn't hear one word yesterday about government debts and deficit spending. Not one question, not one mention of fiscal policy at that meeting. That was a total surrender by Jerome Powell. Janet Yellen made him her, I don't want to say it, I don't want to get flagged for profanity, but that was an outright surrender. Powell will not be remembered as a Volcker. He has guaranteed that with what he said yesterday. Thank you very much, Easy Fix, for the super chat, the support of the channel. And thank you, Mike from Robin RC BatSafe. Says ES1 S&P futures 18 points from STH. I think that he probably meant to say an all-time high. Will rip. Yeah, Mike, you made that call on our Patreon Zoom call last week. He said, do you think we could see an all-time high in the S&P 500 before Christmas? And I was doubtful once again of Mike's bullish calls. And yet here we are, only about 90, I think 70 points at this point away from an all-time high. And the futures are saying we're even closer. So, Mike, congratulations on another good call, much like that 4,600 in the S&P call. I mean, we blew right through that, hit 4,700 yesterday. So onward and upward to new highs. Another good call, sir. Congratulations. And thank you for the super chat, the support of the channel. And thank you, Steve Woitis says, RE, the rate cut chart. Unemployment rise during rate cuts is counterintuitive. Is this because the Fed is lagging behind with policy? Yes, Steve. In short, yes, that is why. The Fed doesn't cut rates because things are good. And that's what the market isn't understanding right now. Or maybe that's what the market is just, maybe the market is betting that the Fed is just going to try to like skip over the pain and go right to the good again, which would be incredibly inflationary, I would add. But the Fed cuts rates in response to some negative event, right? You cut rates to spur economic growth. You don't take action, inflationary action to spur economic growth because things are so good. You just don't do that. So what the market is celebrating right now is that things are bad enough that the Fed might be close enough to doing that. And keep in mind, when the Fed goes Zerpenber, which is the response to every crisis is Zerpenber, well, that drives the wealth gap higher because the people lose their jobs in the economic downturn. And then the Fed prints money. They'll give us a couple of bucks in stimmies and they'll say you're welcome. But really, when they print money and lower rates, it's a massive handout to the ruling class, to the banks, to the super wealthy. And then the inflation makes the poor people even poorer, even though the people who own the assets get even richer from the inflation. And so that wealth gap just continues to get wider. That is what Wall Street is celebrating today. That is the euphoria in markets right now. And that's this big disconnect. Why we're getting these gaslighting articles in Bloomberg and all the mainstream financial press, which is owned by the people who benefit from this. I want you to understand that, guys. CNBC, Bloomberg, all these big financial press outlets are owned by the people who are benefiting from this exploding wealth gap. That is the result of this inflation rate hike cycle. They are sitting there telling you guys, you've never had it so good, right? Claudia Sahm, that schmuck former Fed who made the ultimate gaslighting post, who said, this is crazy. People, the vast majority of people are better off financially, full stop, the other day. And then she blocked me when I called her out on it. Oh, that's nice. Block anybody who questions what you say. What a wonderful philosophy. They're gaslighting people. That's not rain dripping down your back. That's why this huge disconnect. It's not bad vibes from social media that has people doubtful about the economy. It's the fact that the average person is paying almost half of their paycheck just for shelter costs, whether it's rent or owning a house. That's why people are pessimistic. It's not because of bad vibes, Jim Cramer, Claudia Som. So yes, Steve, sorry about the rant there. It is the Fed policy is lagging. Anticipating rate cuts now is anticipating being forced to cut rates later. That's my interpretation of this data. And you can see that in that chart of the unemployment spike following the rate cuts. They're trying to stop that spike in unemployment by cutting rates. But as always, the Fed is late to the game, much like when they, during transitory, when they kept printing money and they're like, no, there won't be any inflation. By the time they acted, it was way too late and inflation came shortly after that. So as always, the Fed is looking in the rearview mirror while driving in reverse or while driving quickly. They're going to crash into something. Thank you, Steve. I appreciate the super chat support of the channel. And thank you, Mike, who says California's $68 billion budget deficit. Great economy. Good point, Mike. Cali's running a $68 billion budget deficit, and we are not yet in a recession. That's important, Mike, because remember what happens to budget deficits during recessions? They don't get smaller when tax revenue collapses and when more people begin to become net consumers of government services in the form of entitlement programs, unemployment benefits. That California $68 billion budget deficit is going to get a whole hell of a lot worse when the recession officially starts, whenever that is. So yeah, people fleeing the state, $68 billion budget deficits. You have to lock up a box of freaking tissues in that state. And okay, that guy wants to be president. Good luck. Good luck, Gavin. Thank you, Mike. Appreciate the super chat, sir. Support the channel. And thank you, Thurston Mellon III. Says, I'm starting to think that everything I learned in school is wrong. Maybe financial physics no longer applies. Arg. Thornton, I'm amazed you even learned anything about finance in school, because I spent the first 24 years of my life in the education system, and I didn't learn anything about finance. Not anything. What the heck was inflation? About the relationship between bond yields and bond prices? Nothing. You know what I learned about finance in school, in college especially? When I was in engineering school, what I learned about finance is if I sign up for a credit card, I'll get a free beer koozie. That's what I learned in college, because everywhere you went, every class, every time I went to the student store, every time I went to the dining hall, get something to eat, I had to walk past a table that was offering me some free stupid thing in order to sign up for a credit card, because they knew that college students spend money recklessly and that mom and dad would come to the rescue with a bailout if they got too high into credit card debt. Dang, if that isn't a metaphor for our whole financial system. Thank you, Thornton Mellon III. I appreciate the super chat, support of the channel. Inflation Situation says, Merry Christmas, JG Nuke. Don't spend it all in one place. Well, thank you, the Inflation Situation. I shan't spend it all in one place. I'll be very careful. I guess I'll take it to the dollar store then, where I cannot spend it all in one place, because I think the dollar store is about the last place on earth where you can still spend less than $5 in one place. Appreciate the super chat and support of the channel, sir. And thank you, M&J, who said, is it time to buy reverse ETF? Crash incoming for 2024. So we're near an all-time high. Right now, probably not a good time, because you've just got euphoria right now. Let this euphoria boil for a little bit. Let everybody pile in before you try to do this. Again, not financial advice, not a financial advisor. I can tell you guys, my shorts got absolutely crushed earlier this year. So, I'm not a market timer. All right? I don't want to sell myself as a market timer. I think we've established I'm not. That being said, the time, when everybody else is euphoric, that's when you want to be fearful. When everybody else is fearful, that's when you want to be greedy. But those reverse ETFs, they bleed cash. So you need to be right about when, not just be right about what. Especially those levered ETFs, they're lousy long-term holds. So be careful with that. I can add, guys, while I've been bearish all year, while my shorts have been getting crushed, I can tell you things like gold and silver and Bitcoin have done phenomenally well this year, offsetting the shorts that haven't done well. I've been making 5 and change in T-bills, sitting largely in cash this whole time. So, being a bear is not that expensive in a bull market if you're careful, if you don't pile all in, if you don't use too much leverage, if you don't go too far out on that branch, you'll be okay. So is it time to buy the reverse ETF? I'm going to say not quite yet. We're probably going to rally for the next few weeks here. I could be wrong about that, but right now the market is just dead set on going higher. Also, keep in mind, the black swan event in the bond market. The reverse repo still has a lot of money. The reverse repo draining down. It's at about $820 billion right now. As the reverse repo drains, that is money coming from the sidelines into circulation. That is stimulative. All right. It is adding liquidity. The reverse repo drain down is adding liquidity into the market. So as long as that's going on, you've still got a bond market where you're probably going to see yields continue to head lower. Another thing to think about is even when reverse repo gets empty, the Treasury General account, they've got $800 billion in the Treasury General account. So Janet Yellen can just decide it's an election year. I don't want to issue too many bonds and cause a black swan event in the bond market that will sabotage my boss's chances for reelection. So I'm going to stop issuing new bonds and I'm just going to spend down the money that I already borrowed. That could be a net addition of liquidity to the bond market by subtracting negative liquidity. So that could further delay when this bond market catastrophe actually happens. So, there's a lot of things that they can do to make this last longer. So just be careful. Don't go too far out on leverage. And always remember the saying, I can't believe I'm going to quote Keynes again, markets can stay irrational longer than you can stay solvent. So thank you, M&J. I appreciate the super chat and the support of the channel. Thank you, everybody, for having your coffee with the Melon Heads. Number go up. And, thank you also to my Patreon supporters for everything you guys do for the channel. I got links down below to all that good stuff. Hi, Mom. Hi, Dad. Love you guys. Till next time, live small and dream big.